Thank you, Annette, Luis, and also Jim Paterba for inviting me to deliver this lecture. And thank you to Ralph for helping me prepare the slides and for all the years we worked on this agenda together. It's been a real pleasure. Thank you. So the intent of this talk is more to give you an introduction to demand system asset pricing for those who may have heard about what demand system is, but maybe don't have an intimate understanding of how it works. And I have to apologize in advance. My citations are incomplete for the reason that I've limited time. This literature is fast expanding, and we don't have time to cover all the papers. But if I miss your citation, please forgive me. Okay, so what is demand system asset pricing? So simply put, it's a framework to try to understand asset prices in relation to portfolios, beliefs, and fundamentals. So by fundamentals, we mean like things like firm characteristics and macro state variables or outcomes. And in order to study asset prices, we want to use, of course, data on asset prices and fundamentals, as you would in like from a French model. But the key aspect of this is now we want to bring in portfolio holdings and portfolio flow data. And that's the kind of the new aspect of this is like when I took asset pricing in graduate school 20 years ago, there was no mention of portfolio data, even though all of asset pricing models are based on portfolio theory, optimal portfolio choice, and market clearing. Okay, so it was kind of like we didn't even think about like using portfolio data to do equilibrium asset pricing, but it's kind of strange to like do asset pricing without portfolio data if the micro foundation is really about portfolio choice. We emphasize concepts like demand elasticities and demand shifters as useful moments to understand where asset price movements come from, which is in the like kind of the microstructure literature, but maybe like we didn't talk about elasticity so much in neoclassical kind of CAPM type asset pricing. It is a new approach to asset pricing, but it's not a new theory. So the way I want you to think about it is it's a way to test existing theories, but also to give us ideas about where we should put efforts in terms of developing new theories. So all asset pricing models imply a stochastic discount factor and a demand system, right? So that's no exception, right? So it's not like some models have asset demand systems and others don't. No, it's all models have an asset demand system and an SDF representation. So the way I want you to think about demand system asset pricing is we're testing different implications of the same model. Okay, so you can test the models based on implications of the SDF, or you can look at the portfolio data and test the different implications that the same model using portfolio data. Some models are going to have more realistic demand systems in the sense that they imply more realistic demand elasticities that are consistent with empirical evidence, or shifts in demand curves that are consistent with portfolio data. So having more realistic demand systems are going to allow to answer a bigger set of questions in a quantitative way that we wouldn't be able to do with models that have less realistic demand systems. There's some confusion about like what are we actually assuming when we have a demand system, and some people think, well, it's about intermediaries or it's about frictions. Maybe some people would even go as far to say, well, you need arbitrage to get demand systems. And none of that is true. You have a demand system in every asset pricing model, so it's not particular to these particular frictions, but these frictions could help us build a better demand system that describes the portfolio data better. Also, like some people think, like, well, demand systems are automatically about inelastic demand. You have a demand system in the traditional CAPM2, the mean variance demand system. So it's not really necessarily about inelastic demand, although using demand systems, you might conclude that demand looks inelastic based on estimates. So the reason we need a demand system is a lot of questions that we're interested in asset pricing deal with like shifts in supply or demand. So like an obvious one is work that Annette and others have done on QE or QT. So when the government buys a lot of bonds, what happens to yields? So that's like an explicit shift in the available supply of bonds that are available to private investors. There's a lot of interest now in what does US-China or maybe US rest of the world decoupling mean to global asset prices? What does it mean to the dollar? How could the dollar weaken when foreigners withdraw from like US markets like treasuries and equities? So that's actually a shift in the demand for US assets from foreign investors. Uh, there's a lot of nice work on how capital regulation in banking and insurance can affect demand curves. So like post global financial crisis, there was a lot of regulation on banks and insurance companies that caused the demand for risky assets to shift in ways that could potentially explain big asset price movements. There's a lot of work on ESG investing, and we saw like good examples of papers like that yesterday, where shifts in demand for green assets relative to brown assets could cause prices and returns to move in the cross section. And then, of course, the transition from active to passive investing can also have dramatic effects on prices and informativeness of prices in equilibrium. So all of these types of questions require you to like think about shifts in supply and demand, and looking at portfolio data is a natural way to understand and to answer these questions in a quantitative way. In terms of like how demand systems relate to the earlier literature, we definitely build on like the classic Brainard and Tobin type asset demand functions and macro models. And in international literature, there's a classic paper by Curry that it's called the portfolio rebalancing model. And so these models definitely thought about like demand systems and even thought about estimating demand systems. And relative to this older literature, well, we have like lots of modern amenities. We have big microdata on portfolios now that they didn't have access to. And the identification revolution in both economics and finance has helped us think about identification issues more carefully, and we have much better instruments. As I mentioned already, market microstructure has also thought about supply and demand, but the focus there is more on high frequency and demand shocks. Now we can use lower frequency identification methods to think about differences in price levels, not just returns, and how demand shifters are causing these differences in price levels. Another innovation is to think more carefully about how to do counterfactuals using demand systems. That's mostly absent in the microstructure literature. Now, the way we identify demand is definitely related to like things like index effects, right? So what happens to prices when a stock gets included in an index? Relative to that, we can now do identification not only on like the set of stocks that get included or excluded, but on the entire cross-section of stocks. Okay, so like a stock on the cusp of Russell 1000, 2000 might not be representative of stocks in general. Okay, so we want to be able to estimate elasticities for all stocks, not just like these stocks that are in the cutoff. There is a literature that uses portfolio flows and for example, Covell Stafford, and in insurance literature, Andrew Lewis has been using these types of or showing these types of effects where if you see like dramatic portfolio flows, that seems to correlate with both contemporaneous and future returns. So relative to that literature, we're going to think more carefully about how to identify demand curves and think about demand shifters as causal in causing prices and returns to move. So at the center of demand systems is like we need to use portfolio data. Okay, so what kind of data do we use? In the US stock market, the primary data is SEC Form 13F. So these are institutional holdings that are greater than 100 million, and its coverage is since 1980, and it's a quarterly filing. FactSet ownership is a version of 13F that provides that data in a convenient format, And also, we also have mutual fund holdings through FactSet ownership. So for example, you can break up Fidelity and Vanguard into its individual funds. Thomson Reuters EMAX is quarterly bond holdings of primarily insurance companies and mutual funds, but it has some international coverage as well. Schedule D is a regulatory filing of insurance companies, and this is kind of nice because it not only has like public assets like bonds and stocks, but it also covers private assets and real estate. And then in the euro area, we probably have the best data on portfolio holdings. So these are comprehensive holdings for the euro area, and it covers at a quarterly frequency since 2014. So the key features of these data sets is they're very large data with 3 dimensions, right? So you have investors that are holding the assets, and you also have a time dimension. So it's like a triple dimensional data set instead of the conventional double dimensional, which is firms and time. These holdings data do not complete they sum up to total assets outstanding. So the direct household holdings, for example, in the 13F data, is the residual if you take the market shares outstanding, subtract institutional shares. Okay, so then that raises the question of like, well, can we break up the household holdings to understand the household sector in more detail? And to do that, you can go to other countries like Sweden, Norway, and Brazil. But also in the US, this data at a par covers US for a share of the US households, especially on the high end of the income distribution. Okay, so the outline for today's talk is to kind of break down asset pricing into its essential steps. So first is there's always a micro foundation, is an asset pricing model that gives rise to both an SDF and a demand system. And I'm going to explain to you what do I mean by like a structural demand function versus the reduced form. It turns out that if you want to just do prediction, then you can work off of the reduced form without identifying price elasticities of demand. And this is the technique that we used in the paper yesterday. If you attended the paper on credit ratings and credit spreads that I presented yesterday in the asset pricing group. And we have an earlier paper called Asset Embeddings where we also apply this technique. Okay, so some people think like, well, with demand systems, you need to identify elasticities to be like useful. Well, if the goal is just prediction, you don't have to go that far. Without any identifying assumptions like that require you to do IV, without doing that step, you can actually do predictions based on principal component analysis of holdings data. Now, if you want to go further and make further assumptions, you can do identification. So that's the third step. And that's what we do in the original 2019 JP paper, as well as some of our subsequent work. And there you have to think very carefully about identification and instruments. And I'll go through a very simple example that explains the identification, I think in a fairly transparent way, because I think there is some confusion about how identification works in this setting. Now, once you identify demand curves, you have elasticities and demand shifters that are identified. And that's going to give us a lot of input into how do we calibrate things like preferred habitat models or structural models of macro asset pricing. So I want you to think about these demand elasticities and demand shifters as essential moments to test existing models and to develop new ones. Once you have a demand system, of course, you can do counterfactuals. So like the Ishita's paper that she just presented is a good example of using a demand system to do counterfactuals. Okay, but the way I want you to think about this is like, well, from prediction to identification to counterfactuals, you need like more and more assumptions, but then you can do like a richer set of experiments that might answer your question better. And when you do counterfactuals in the fourth step, you're not allowed to just say, well, this is my estimate and this is the counterfactual. You can actually test your counterfactuals out of sample. So we actually have a very simple example of that in the JP paper where we try to predict returns out of sample to kind of confirm that the structure that we estimate seems to have some predictive ability. Okay? All right, so usually I don't want to do equations in a keynote, but there's a minimal set of like ideas that I want to set up front to kind of connect what is the SDF representation versus what is a demand system. So this is essentially the CAPM with one twist. Okay, so the way CAPM works is there's n assets, 1 through n, and there's a price for each asset, P and T, at time t. And then this is a static, very simple asset pricing model where the payoff happens next period at t plus 1. Okay, so D is the dividend at t plus 1 on asset n, and think of n as, let's say, NVIDIA shares. So that has some kind of a mean expected dividend, and riskiness of dividends depends on a factor exposure to an aggregate dividend factor F, and the factor loading psi, and then mu is the idiosyncratic risk. Okay, and we're going to do the standard carrot normal thing where we're going to assume both the factor and the idiosyncratic risk. Idiosyncratic shock has a normal distribution. And then the factor loadings, psi, and the expected payoff phi are functions of characteristics. Okay, so this is not that different from like a Fama-French type thinking where, right, expected returns and factor loadings are ultimately functions of observables x. And then the additional thing here is, well, it could also depend on unobservables, unobservable to the econometrician, but information that investors have that are that they're using to do the portfolio choice. You can invest in these risky assets, or you can invest in a riskless asset, and we're going to normalize the interest on the riskless asset to 0. Okay, and it's in fully elastic supply. So, okay, so this is a very standard CAPM setup. And then we complete it with investors. So there's I investors, and they care about their wealth at t plus 1, which is a consequence of their vector of portfolio, Q, times the return on your portfolio. So the payoff minus the price. Investors are going to disagree about the model of expected payoff and the factor loading, right? So with a homogeneous beliefs, these phi's and psi's would be just indexed by t and not by I. And then same with the unobserved characteristics that determine the expected payoff and the factor loading. Okay, so the key here is that both big phi and little phi are indexed by I. So you can have like different models where you're translating characteristics like profitability into different estimates of expected payoffs and factor loadings. And the reason we do this is without this feature, then this is standard CAPM. So two fund separation applies. Everyone's going to hold identical portfolios of risky assets, and that's not very amenable to explaining actual portfolio data. So the only reason we do this is, okay, so how do we get heterogeneity in portfolios? This is a simple mechanism to do so. Okay, so otherwise, it's a standard optimization problem, exponential utility with risk aversion gamma I that's heterogeneous across investors. And the first order condition is the standard Euler equation. So marginal utility times return is equal to 0. Okay, and that's a vector for all assets. So this is what we mean by the usual SDF representation, right? So there's a stochastic discount factor that prices all assets. Okay, so this is where the demand system comes in. There's another way to represent the same model's equilibrium as optimal portfolio choice. And this is like, for example, emphasized in the great work that Luis has done with John Campbell over many years, right? So which is portfolio holdings of investor I for asset N, let's say NVIDIA at time t, is a function of the price of NVIDIA shares, the characteristics of NVIDIA shares like profitability, that's the X, and some unobservables that investors have about NVIDIA, like how bullish are you about AI, and that's in epsilon. So what we call price elasticity is this pi IT, which is heterogeneous across investors. And what we call a demand shifter is this part that depends on observed characteristics and what we call latent demand epsilon. Okay. So we can actually write down the formula for elasticities. It's just 1 over risk aversion times sigma squared, where sigma squared is the idiosyncratic volatility. And given my assumption that idiosyncratic volatility is constant across stocks, then you have essentially elasticities that are homogeneous across assets for a given investor. Okay, and then there's a lot of debate about, well, are elasticities like structural parameters or not? Well, in this very simple example where admittedly I made like very strong assumptions, it's a function of 2 structural parameters, sigma squared that's determined by the technology, homoscedastic, and risk aversion gamma I. So it is a structural parameter. But I can write down another model where it wouldn't be because sigma squared would be endogenous. Okay, so it really depends on the assumptions of the model where like elasticities are structural parameters or not. And that's sometimes a source of confusion. It's really about the assumptions in your model that deliver these elasticities. Now, these betas are elasticities to characteristics, right? So holding prices constant, how much does AQR tilt towards more profitable stocks? That's the beta I. Okay, and that's a function of phi I, which is my model for expected payoffs, and psi I, which is my model for factor loadings. Okay. And then the other source of confusion is like when people look at this equation, they say, no, this can't be consistent with mean variance because it looks like the demand for NVIDIA shares only depend on prices and characteristics of NVIDIA shares. But we know that in portfolio choice, it has to depend on the whole vector of prices, including Facebook and JP Morgan. So where did all the other prices go? And it's all like folded into this kappa I, right? So kappa I is a function of the vector of prices and the vector of factor loadings. So it does depend on the entire vector of prices in a standard mean variance way, but it's all folded into this beta IT, which is a function of this kappa IT. Okay, so it kind of like the formula is deceivably like too elegant. Like it almost hides this dependence on the entire vector, and that's often a source of confusion. But this is really the strength of the factor assumption is it makes the demand function now very amenable to a regression analysis, right? Because now it looks like I can simply regress portfolios of NVIDIA versus Facebook on the relative price, relative characteristics, and you have the residual. Now you can see, though, that once we do equilibrium, it's not so easy to do demand estimation, and the reason is the following. So equilibrium prices have to clear markets, so there's supply equal to demand. So I plug in my demand function here, and I solve for the equilibrium price, and now you can see that prices depend on the average epsilon latent demand across investors, right? So that induces a correlation between, if I go back to this equation, latent demand and prices that are direct functions in equilibrium of latent demand. So that's the endogeneity problem. So we need an instrument for price. Okay, and when I go to the identification part of my talk, I'll describe how to do that. In terms of terminology, I want to be clear about there's a aggregate demand elasticity here, pi bar. So this is the average elasticity across investors. And then 1 over pi is what we call price impact, or sometimes the multiplier. It's the inverse of the demand elasticity. Okay, so now established kind of the common language. There's demand shifters, right? There's the elasticity for individual investors, pi I. There's the aggregate elasticity, which is the sum of those, and the price impact is the inverse. Okay? And I'll be using that terminology in my talk. Okay, so what do I mean by the reduced form? The reduced form is like I take the demand function here and I substitute out the equilibrium price. And that's like exactly equivalent to if you have a 2-stage least squares problem, you can substitute the first stage endogenous price into the second stage, derive the reduced form. So the reduced form now doesn't depend on the price because you substituted it out. So portfolios depend only on supply and characteristics, this right, vector x, and lambda I is a sensitivity to those characteristics. So the reduced form doesn't have a price. It has a factor structure, lambda I, investor, times xn, asset. And this is what you can estimate by principal component analysis. What we call investor embeddings are the lambdas, and what we call the asset embeddings are the x's. Okay, so given that structure, without instruments, we can estimate x asset embeddings by PCA, and we can apply it to a lot of prediction tasks, including the credit application yesterday and to equity markets in our paper, asset embeddings. Okay, so demand systems are already useful without identification by just using the reduced form representation. Okay, we identify these X and T's to say, well, we can use basically characteristics that are implied by a portfolio to compare, do comparisons across firms to say like, well, Facebook is similar to Google and so on. Okay. All right. So this is like kind of overview of like, well, given that really basic micro foundation in a linear model, like where do we go from there? So the micro foundation depends on the asset market we're studying and the data structure or the data that we're trying to explain. Okay, so in the original Yogo paper in 2019, our micro foundation was not Kara normal, was log utility. And we had short sales constraints that gave rise to positive portfolio weights and investment mandates that gave rise to very concentrated portfolios where, for example, like technology funds only can hold technology stocks. Okay, and then depending on other applications, we had versions where we had background risk or direct taste for characteristics like ESG, and my paper with Ralph and Rob. If it's an insurance context, risk-based capital constraints matter. In a multi-country world, we did a G version of this with multiple countries and asset classes that gave rise to gravity relations. And then Xavier and Ralph have a paper doing this with dynamics in an infinite horizon model. Okay, so there's no like one micro foundation for demand system. The micro foundation or the asset pricing model you write down depends on the application and the asset market you're trying to study. And as a consequence, there's no one concept of elasticities. The elasticity depends on, right, which elasticity. Is it for corporate bonds? Is it for equities? Is it for micro elasticities for like NVIDIA, or macro elasticities, which are the elasticities between stocks in general and the bond market? Okay, so you need to be careful about like what when you say elasticities, like what asset, which country, and so on. Okay. And then a lot of people think like, well, demand systems is all about logit demand. That was our first model, but we've gone way beyond logit now. So we can do nested logit to allow for heterogeneous elasticities across asset classes. Also, we've done asset embeddings as a way to properly or more properly control for characteristics to get richer substitution effects. Okay, so it's not just logit, it's various functional forms that are increasingly more realistic for the application at hand. Okay, so I want to like explain like what goes wrong if you have the wrong micro foundation on the wrong estimator. And there's a critique of our original JP paper by Fuchs and co-authors that you may have come across. And Ralph and I are writing a full response to that paper now, which shouldn't be available. But I want to kind of summarize like what goes wrong in their critique. Okay, so both in our paper and their paper, we start with the mean variance portfolio models. Okay, so no disagreement there. But we make different assumptions about the technology. So we assume that like in my example that I already showed you, there's a factor structure and payoffs or returns. And those factor loadings and expected payoffs depend on characteristics that give rise to a logit demand function. They instead write a technology where there's two assets that are perfect substitutes. They call it red and green, and there's a complement asset that we are going to label as C. So as a consequence of a different micro foundation, right? Well, these models are designed to explain different data. Ours is designed to explain the US stock market, and theirs is designed to explain something else, not the US stock market. The elasticities in our model are determined by pi I. So this is investor-specific coefficient pi I that shows up in a demand function. And nice thing about logit is you can explain all the elasticities and cross elasticities with just one parameter per investor. Okay, so that's the dimensional reduction that comes from the factor assumption. in their model, they have two elasticities. The one between red and green, almost perfect substitutes, are going to be very high. And the one between red and the complement asset's going to be much lower, right? Because they're very different assets. Okay, so they have two parameters. And then we estimate our pi I through cross-sectional IV, and they estimate it. So in their setting, you have to be clear about what are you trying to estimate between red and green or red and the complement. So they incorrectly interpret our estimator as the estimator for red versus the complement. But the irony is if you correctly apply our identification equations to their setting, you actually should get the elasticity between red and green. So you would correctly identify the elasticity. Okay, so it comes from misinterpreting what our estimator is actually doing. So that's kind of an example of where you need a proper microfoundation and proper estimator to get the correct answer. Now, let me move on to the prediction part of the talk. So we want to be able to compare. So we want to compare which firms are similar or not similar. And we typically use in economics characteristics to do that, right? So firms with similar profitability or in the same industry are similar. But observed characteristics have limited explanatory power, as we know, for both prices and credit spreads and so on. And investors are using a wider set of information to do portfolio choice and predictions. So for example, like AI capability, intangibles, these are things that are harder to measure with observed characteristics. Okay, so what the asset embeddings do is from the portfolio data, we try to recover all this information, right? What I call little x. And we have different ways to recover this information using PCA, word-to-vec-BERT, that we explain in the asset embeddings paper. So once we recover these asset embeddings, we want to be able to say, well, our model predicts better than alternatives, right? So an obvious benchmark is, do embeddings explain the cross-section of credit spreads or cross-section of market-to-book ratios or valuations better than the alternative like credit ratings or observed equity characteristics? Okay, so we established clear benchmarks for success in both papers. Okay, so we're not wedded to our way of doing things, but what we would like to see is, well, if you have a better model, then let's apply it to the same benchmarks and see which models are better. Okay, so rather than having a conversation about, well, my assumptions are better than yours, we can try to test those assumptions in actual data by making out-of-sample predictions. And that's kind of the vision behind ImageNet, if you follow the AI revolution, right? Is there's a clear benchmark for success, like can you recognize a dog versus a cat, and which algorithms do the best job of doing so out of sample, and that's exactly what we have in mind when we say benchmarks. So we have pictures like this in our asset embeddings paper where we show that relative to a model of characteristics to try to predict out of sample valuations, embeddings, the red bars, do much better. And different algorithms for extracting embeddings have different performance, but they uniformly beat characteristics. And if you use a larger dimensional model, the green bar, you can do even better. So there are additional applications of embeddings. Embeddings are fundamentally about comparing assets or investors, right? So based on embeddings, we can do generative portfolios, right? So based on your current portfolio, I can make the next recommendation, right? How can I do that? Well, I can get the embeddings for your current portfolio and see which stocks have similar embeddings to your current holdings. Okay, so that's a generative portfolio. We can do stress testing in the fixed income market. We can also compare across bonds or firms and say, in the primary market, can we find buyers for this bond based on what they already hold? We can do matrix pricing for bonds that are not traded in the secondary market and so on, right? So it's fundamentally about coming up with a richer set of characteristics through the holdings data. In terms of investor embeddings, so these are the lambdas, you can do investor classification. So we kind of know that typical classification, like whether you're insurer or whether you're large or small, doesn't have much explanatory power for portfolios, but embeddings capture the entire essence of differences across investors. So that might be a better way to, for example, do portfolio evaluation, right? So if you want to like evaluate AQR's performance, what are the closest relevant peers to AQR in terms of distance in terms of investor embeddings lambda. Okay. So I want to move on to identification, and I want to spend a bit of time on this one because this is often a source of confusion. So we can rewrite market clearing in the following way. So the demand of investor I for asset N, right, is equal to the supply of asset N minus the demand of all the other investors. So this is an accounting identity. And what we call the right-hand side is residual supply. And this is not language that we invented. If you read like Kyle's original paper, he also uses language residual supply. Now, what's kind of unique to identification and asset pricing is like if you talk to anyone outside of finance about identification, they think, well, to identify demand, you need variation in supply. But that's different from in finance, we need variation in residual supply. So even if you don't have variation in supply, actual supply, you can get variation in demand of the other investors. That's going to give you identification for the demand curve for investor I. Okay, so that's often a source of confusion, and we have difficulty explaining it to people outside of finance. But in finance, okay, you know the concept residual supply. So I'm going to illustrate in a super simple example, like how this would work. So consider a world in which there are US and German investors, and there are Dutch and Australian debt. Okay, and this is kind of like how I want to illustrate it. So there's US investors investing in Dutch debt and Australian debt. And there's German investors that are investing in, again, Dutch and Australian debt. Okay, and assume that US investors are essentially equidistant between Netherlands and Australia. But obviously, Germany is a lot closer to the Netherlands than it is to Australia. And I'm going to draw the supply of debt for Australia and Dutch. These circles for Dutch and Australia, the outer circles are the same size. Okay, so assume that there's actually no variation in supply of Dutch versus Australian debt. So because we have no variation, we have no identification through supply. But we have identification through residual supply because German investors have higher demand for Dutch debt than Australian debt through some kind of information friction that gives rise to a gravity relation. So the residual supply that US investors face in Netherlands, right? This is a crowded market because they're competing with German investors who really like Dutch debt. So they're going to go to Australian debt where there's plentiful residual supply because German investors don't like much of Australian debt. So it turns out that the instrument for estimating US investors' demand is actually the distance between Germany and Netherlands and Germany and Australia, right? The physical distance. Okay? And let me show you that in math. So in math, we have the same linear demand function that I showed you earlier, which comes from a Cara-normal model. So you have US investors and German investors. Their demand depends on the price, the bilateral distance between US and Australia and US and Netherlands, and epsilon's a latent demand. Okay? And we have market clearing for both Dutch and Australian debt. They're held by German and US investors. So I substitute the demand function into market clearing, and I get the equilibrium price here. So the equilibrium price of Dutch debt is equal to the distance between Germany and Netherlands, US and Netherlands, and the latent demand of German and US investors and the supply of Dutch debt. Okay, so what's the endogeneity problem? Well, I'm tempted to regress the cross-section of US holdings. So US holdings for Australia and Dutch debt, so 2 data points on 2 prices, Dutch and Australian debt prices, the bilateral distance between US and those countries, and then latent demand, 2 data points. You can run this regression in OLS, but unfortunately, the OLS estimator is going to be biased. Why? Well, P is an equilibrium price that depends on the latent demand of US investors here, right? So there's a mechanical correlation between epsilon here and epsilon here. So that's the endogeneity problem. So you need something that affects the price that's not correlated to US investors' demand, But the instrument is the bilateral distance between German investors and the two respective markets. Okay, so the relevance restriction or the relevance condition in IV is I need something that's correlated with the price that doesn't depend on the demand of US investors directly. Well, the instrument in this case is the distance between German investors and those two markets. Right. So if I go back here, right, the distance between US investors and these markets enter directly in demand, but the distance between German investors and these two markets are going to be my instrument. Okay. And of course, the exogeneity assumption is that the distance between German investors in those countries doesn't enter US demand directly. Okay, so now we have a proper IV. So what does the original Koi and Yogo paper do in terms of IV? Well, it's exactly this example, but replace US investors with a total market fund and German investors with a banking fund. And the banking fund can hold JP Morgan, but it cannot hold Walmart. Okay, so the relevance condition is that the JP Morgan is going to have a smaller residual supply because it's held by the banking fund. But Walmart has greater residual supply. And then the exogeneity assumption is that the investment mandates of the banking fund doesn't enter the total market fund directly. The index effects is a difference in difference version of the same instrument, right? And there's other instruments in the literature. Payout-induced trading looks at basically rebalancing, similar to like Cam Harvey's paper yesterday, but looking at actual rebalancing from the microdata. And in our paper on QE, we had a very fortunate natural experiment where the purchases of Euro Central Bank across the different countries were proportional to the capital key, which is an average of GDP and population, and not proportional to debt outstanding. Okay, so you get variation in demand of ECB, where you get a lower residual supply in countries where right, you have a populous country with a smaller debt market. And of course, there's the granular IV as a way to estimate macro elasticities. Now, if you look at actual elasticity estimates in the literature, they're kind of uniformly low across different markets. And some of these are macro elasticities, some are micro elasticities, and it uses different identification techniques. But the key point is that they're uniformly low, much lower than what you would get from like a CAPM model. We have estimates of elasticities in our JP paper. So the inverse of the elasticity is the price impact, right? So the price impact measure is around 3, but it kind of has a trend. So markets are becoming more elastic over time. And it has a cross section. So some stocks are more elastic than others. The other thing that you see here is a cycle. So price impact tends to go up in recessions like 1991, global financial crisis, and the 2001 recession. Okay, so markets become less liquid in bad markets. Okay, so we have price impact measures based on the Euro QE experiment, where the implied elasticity is around 3. And if you remember Christie's paper yesterday, I think she cited a number close to 5. So there's some agreement in terms of like government bond elasticity seem higher than equity elasticities. The last part of my talk, and you want me to end like in 3 minutes or? Yeah, okay. Last part of my talk is focusing on like what are the counterfactuals we can do using this demand system framework. And the reason we want to do counterfactuals is 2 reasons. We want to understand like why prices move, and which is a very ancient question that goes back to Shiller or even before Shiller. But we also want to make predictions using demand systems that confirm the structure. Okay, so 2 examples of that is what caused prices to move during the global financial crisis? And can we use the demand system predict future returns? Okay, so auto sample predictions. So this is like an example of output we can get from this structure where we can decompose the cross-sectional variance of returns between 2007 and 2008 into which institutions' demand shifts are causing prices to move. And we can go institution by institution. So Barclays, which is now part of BlackRock, Fidelity, and so on. And the last column here is the percentage of the overall variance that these institutions contribute to. So, for example, Fidelity accounts for 1% of 1 percentage point of the cross-sectional volatility of stocks. So if you add up the top 30 institutions, you get to around 4%. But the top 30 institutions are actually 1/3 of equity market holdings. The smaller institutions account for 10 times much volatility, 40%, and the households account for 46%. Okay, so this gives a very nice picture that it's the smaller institutions and the household sector that are seem to be causing have more active demand shifts that are causing prices to move, at least in the during the crisis. Okay, and this is the predictability evidence. So we can try to predict cross-sectional returns out of sample. And our signal is we're going to predict that there's going to be mean reversion in latent demand. And this predicts returns with a very significant coefficient controlling for the standard characteristics, including book to market. So this contrarian strategy based on latent demand actually predicts returns better than book to market ratio, which isn't significant in this sample period. Okay, so we're going to use these estimates of demand shifters and elasticities to talk about macro finance and more structural models. And the basic equation is, again, through market clearing, prices have to depend on elasticities and demand shifters. Okay, so since we have estimates of both elasticities and demand shifters, we can say, well, when you see observed volatility in returns, right, is it caused by low elasticities and uncorrelated demand shifters, or high elasticities and very correlated and violent demand shifters in the aggregate? Okay, so the way like neoclassical models would work is, well, you have highly correlated demand and very elastic demand. But models with intermediation like Vallanos Villa works with lots of inelastic investors that are caused where right now price impact is much higher, and you have somewhat uncorrelated demand shifters. Okay, so the estimates of demand shifters and elasticities can be very useful for calibration and to guide these models, as we saw in the previous paper Ishita presented. The variance decomposition that I showed you reveals like whose demand shifts are causing prices to move. Is it BlackRock? Is it Fidelity, or lots of smaller funds? Okay, so we can really understand now, like, what are the sources of volatility in financial markets? Like, which investors? Is it broker dealers, insurers, hedge funds, and which markets are causing prices to move? And this can guide research in intermediary asset pricing. So in terms of promising directions for future work, there could be further improvements in our models of asset demand, and there's a lot of work in that area. Of course, there's always ways to improve identification. We want to connect demand shifters to survey expectations. So when I was hearing Stefan's very interesting presentation this morning, I was also like trying to connect it to, for example, work Ricardo Rice has done on inflation expectations that come from portfolio data. Okay, so how do these two align, like Ricardo's papers versus Stefan's paper? That would be like a great research agenda. And then of course, you can resolve longstanding puzzles in asset pricing, like why does green stocks move relative to brown stocks, which investors are causing it to move? In terms of corporate finance applications, we can think about preferred, like if you think about estimating demand for green versus brown, then we can test catering theory, right? So Simon O and co-authors have a very nice paper where they're using a demand system approach to try to predict which firms are going to cut emissions. Lira Mota and Kirisiani have a paper trying to predict like right how different investors have different preferences for the things like covenants and maturity and seniority, and whether firms are catering to these investors by precisely issuing those types of bonds. And more generally, like catering theory can apply to investment, capital structure, and payout policy. So these could be very good applications of the demand system approach. Thank you.